Good evening. This is Dr. Ken Long from Tortoise Capital Management on January 26, 2014. And I want to discuss a concept we call swing trading one day at a time. And it's our method of integrating uh, swing trading and intraday trading, or trading from two different time frames each day. So we can think of swing trading as being a top down process or a bottoms up process and wonder which one is proper or correct or works better. And so I distinguish between them as in the following way: that a top down approach is a deductive approach. It starts with something like an if then hypothesis, where based on study and pattern recognition, back testing, you develop a pattern and criteria and conditions which suggest that the market has moved into a short term favorable condition, which could mean that there's now a higher probability of a directional move occurring, or a higher probability of an outsized move compared to normal. Over a 5 day period, maybe instead of the market moving 1 or 2%, maybe it has moved 5 or 6% enough times that you're alerted to that possibility of an outsized gain in a short period of time. Or there could actually be a mix of both of those improvements. In either case, you have something that is better than simply just a random day in the market or a straight buy and hold. Now, what gets interesting is when you have that top down approach and you have that pattern, and then intraday, on the day that the signal to enter is going to fire, you start seeing that move happening intraday. It may not have hit that entry yet, but it's on its way. Um, and then when the price triggers the entry intraday as the official mechanical entry, you're justified in taking a position either mechanically, like you put the order in the market, or you may exercise your discretion and say there's no other market reasons to not take the entry out, so let me go ahead and take it. Well, that leads you to consider some moments when intraday you see prices moving towards your trigger, but it hasn't reached there yet, and you know that in another 25 cents or 50 cents or a dollar that you want to get in, and everything else in the market is looking favorable, and you might say to yourself, well, all other signs are pointing to yes, let me go ahead and enter and try to get some price improvement on an entry that I am going to want to make in 50 more cents anyhow. So this is a top-down approach that begins with a certain trade logic that suggests why the market ought to reward that swing trade more favorably than the average random period in the market, and then allows you to derive the rules and principles for applying the trade. So there's a trade idea that suggests why it should work. A bottoms up approach I would distinguish as an inductive approach, which is some tentative rulemaking based on evidence. In other words, you see some price behavior and it suggests that there might be an underlying explanation for why it should be working. And with our pattern matching brains, we're almost driven to try to find the reason why price is behaving in a certain manner. And that when you see that pattern apparently repeating, then it leads you to formulate some tentative rules, which might then be coded and could be back tested in a top-down way. But it's based on evidence of price action that you can see before you have a reason why it should occur. But you're seeing what seem to be patterns. We know that momentum in one time frame can be a signal in other time frames. So if you get a big enough move on the 1 minute charts, that may cause a mechanical system to fire on the 3 or the 5 minute charts, or an hourly breakout might be enough momentum to give a day trading or a swing trading system a reason to get in. So that momentum on one time frame again can feed information to higher time frames. We also think that reinforcing feedback loops can generate more stories and narratives, so that if you have a complex model for how the system or the market works in general, and you start seeing pieces of evidence here and there that as you start gathering those little nuggets, you start developing more confidence that a particular pattern is about to happen, where it leads you to chain some decisions together to start building a complex story that explains the market. In other words, you might see some evidence here and there, and you start putting the pieces together, and the and an explanation begins to emerge in which this particular pattern looks like it could be a fill in the blank. In which case, we should then see a follow-on. So you're starting to build an inductive hypothesis for how the market might be developing, almost in the form of narrative sense making. Now, in this particular approach, you might find that you have some intraday trades that are being traded on shorter time periods that could develop some patterns that could grow into being a swing trade over time, simply because price continued to behave in a certain direction even before you have an explanation for it. In fact, you may have developed a swing trade out of nothing more than a series of collected intraday trades. In this approach, the skills you need are the intraday trade framing and then some sense of reward to risk management strategy that allows you to include overnight risk as a component of swing trading in a similar manner that you do to intraday risk and reward framing. In the top-down approach, that reward to risk really takes into account the entire risk over the life of the swing trade, and usually incorporates a blend of both intraday and overnight risk over that time frame. The question to ask yourself in the bottoms up approach is, does it have to make sense to you in the moment, or is the price action that's occurring sufficient reason to get in? And that only you can answer that. So if we take those as two different approaches, let's explore a little bit more deeply, and we'll start with a top-down trade framing, as I call it. So let's suppose that you have some number of swing trade systems as signal generators that are key to certain target or sector or market conditions, which can be coded and defined. And let's suppose that on a particular day, at the close of the day, all the criteria for that trade to fire the next day are in place. That all the price has to do is move through an entry point, in which case that you would have a signal to enter the trade with an initial stop or an I stop that is appropriate for the particular theory behind that trade. So you might say this thing is going to, if it holds true to form, it might move 5% in 5 days, and then an adverse move of this distance between the green and the red line might be sufficient adverse price action to refute the hypothesis or negate the hypothesis, and then that would end up becoming your initial risk. And so that the hypothesis for each of those systems then should also include something like a reasonable price target if it turns out that the hypothesis is true, that the swing trade actually is confirming your hypothesis. Then we ought to be able to estimate some reasonable price target based on either the logic of the trade or the past performance of trades of that type that we can apply some analysis to. And in any case, you'd want to have some kind of ratio between your reward for the average trade and the risk for the average trade that's somehow favorable in your direction, and then the probability of win rates and the average wins divided by the, compared to the probability of the losing trade, and the average loser gives you the basis for computing expectancy to see if you have a trade that is favorable. And so everything up into this vertical blue line at the close of the day, we would think of as studying and stalking, and then you trigger the trade when it goes through your entry. So let's suppose that for one of these, or an aggregate of these swing trades, we have something like an average move, which an X% gain over over 5 days. So let's call that 8% or 10% over the next 5 days if this thing works out on average the way it has. So this dotted black line would give you some kind of sense of the perfectly efficient line, which said if you gain the average amount each day for the average length of the trade, you will get some kind of performance line that looks like the pure average trade, pure efficiency. And then you might ask yourself, well, is there some time by which that trade should be working, should start working if it's going to work, in which case you might have the initial risk at your initial stop, and then at some point pick up a time stop that starts tracking either the price itself, or at a certain period of time maybe this starts accelerating, and it adds a time component to the exit. The trade has to prove itself or not over a certain period of time. You might then say this green line might represent trades that are really outperforming the efficient line by saying, oh, we're getting to our trade targets much sooner. There you have to ask yourself, is that a sign that this is a gateway to a much greater trade, or is it simply the fact that we got very efficient in our use of capital over time, and we shouldn't be looking for more? So analysis of your system will tell you if an accelerated return is a trigger condition for something even better coming, or if it simply means you got what you were entitled to expect, but only in a shorter period of time. That will tell you how you manage that trade. At the same time, you might have uh, trades that aren't quite as good as the efficient line, but which haven't hit their stops yet. And so they might think of them as, well, they're simply good enough to stay in until proven otherwise, either by the stop or by the appearance of better opportunities later that might be better uses of your capital. And then if we think about this tan line being the long-term average return of buy and hold in that symbol, we might have a reason now to favor the swing trade because the expectancy is better than simply buy and hold. And then the aggregate of that system's performance over time would, you could say, would be the system's edge, and you want that to be a positive expectancy system when you factor in the average wins, the average losses, the probability of wins, the cost of capital, the administrative costs, and so forth. Now, one thing we want to remember about all these different systems too is that the market itself is always out there, and it's a very complex system, and it's influencing all of our swing trades, and it could very well change faster than and independent of the forces that are moving our swing trade. So let's suppose we have a hypothesis about a particular sector, and we have all the conditions in place, whether it's a mix of fundamental or technical analysis. And so everything points to yes, and we're stalking that trade, and then all the signals fire, and now we're into this multi-day swing trade, and it seems to be moving up, being propelled by forces that are connected to the trade system's logic. And it may be that that system is working, and maybe even working better than expected, simply because the market itself is in a favorable condition, which is influencing that trade. So you're being carried along by the trade, or the tide of the market, I should say. Whereas the next time you start stalking and you see the setup conditions for that sector, it may be that something has changed in the broader market that is now uh, tending to push this performance down. Whereas all the direct factors that you've accounted for in your system are in place, and you think like it should be working, but it's not working. And it may be simply because the market itself has some deeper underlying forces at work that are undercutting those who would otherwise be interested in buying and selling according to your primary hypothesis. So it's always important to remember that the system that you're trading is a subset of the market, and that there is some kind of relationship between your trade, your system in general, and the market condition, and you want to think your way through that to see what kind of additional variables that represents. So if we think of that as sort of the top-down approach, it begins with an idea, and then principles are derived, then tested, and then traded forward. We can now compare that maybe to bottoms-up trade framing. And so in our view, we're using a couple different kinds of systems intraday, the frog and the regression line crossover system and framework, both of which provide many opportunities each and every trading day in different directions and independent of what happened the day before in the case of the frog. And so we get these coming along every day. These are, I think of them as independent intraday trades with not necessarily having continuation patterns, but each one being self-contained with its own trade logic. And sometimes they are trades that we're going short or when the market's going down, some that are when the market's going up and we're making money. Other times the market could be stable or the signal doesn't follow through and it doesn't give us any directional performance at all for a wash. And so you get this series of independent, maybe disconnected trade patterns each and every day. Well, it may be that some of these, for reasons unknown to us, or maybe for no reason, there seem to be some kind of pattern emerging. So in this one, we might have seen one target which had a couple upward movements during the day, and maybe instead of a pullback, it just stabilized sideways. And so instead of retracing, you end up getting two impulses up, and maybe the next day it gaps down and then follows through to reverse and get back to fair value, and then gets rewarded with a very strong afternoon move, and then only a slight pullback into the close, and then the next day, after a gap down, resumes that strong move up. You might at some point in here say what seems to be emerging is a swing trade over multiple days, but for no apparent reason, or one that doesn't align with any formal swing system rules that we have, but which seems to no longer be independent day to day, that there does seem to be some kind of pattern. Now, if you're able to start identifying patterns repeatedly, you may be able to actually code those conditions and develop some strategies and rule sets that could then be back tested to determine if you've discovered a new tentative hypothesis about how the market might work, and that could lead you to developing a top-down rule-based approach, simply using what I call an evidence-based or inductive approach to developing a swing pattern. A third way you might see some bottoms-up trade framing is in the case of you have an active swing trade already ongoing. In other words, a swing trade that's still open where the exit signal hasn't fired yet, and you might have a core position in that system based on a position size that includes your overnight risk or the risk expressed over the average life cycle of that trade. So it might be something like a 2 ATR or a 3 ATR initial stop, which is gives you enough protection against the noise that you can typically expect in that kind of a trade over its life cycle, and that might lead you to a position size of a certain number of shares. Well, while that trade is open, you might then see an intraday opportunity to turbo that position based on purely intraday trade logic that lines up with the frog and or an RLCO opportunity. So you have a swing position that you've already researched, and you're working your way through support and resistance, and then you see a chance where on an intraday basis there's a favorable moment, and so you might be able to add to that position and have a much larger position intraday that you can manage, and then looking to take off that turbo position before you get into the overnight session in order to carry overnight just the appropriate amount of risk on the basis of the swing trade analysis. And then maybe the next day there's a retracement in there or some profit taking, and you might actually find yourself looking to hedge against the long side position by taking a short position or a position in the futures or with an option or with an index ETF or in a nearest neighbor kind of approach where you're short in something that's similar in order to offset the losses that the longer term position might be taking on. And then maybe the third, but maybe that doesn't actually fire the exit signal for the swing, and so the next day you've still got your core position on, and then you find out, oh, well, the intraday trade is still pointing up, and so you might be reinforcing that core position with a turbo. And so by having done the research on your swing system may lead you to find ways to trade intraday in and around your core position by adding selective turbo positions either in support of or as hedges against the performance of the swing trade over time. So just three different ways that the bottoms up trade framing might actually work for you as independent trades based on their own logic, or lead you towards developing a multi-day approach based on continuation patterns that seem to be emerging, and which may ultimately lead you to new rule sets, or as a way to work to get more value added out of the specific trade systems that you've already developed. And so, to the answer to the question of we started with, is swing trading a top-down or a bottoms-up approach, and what's the relationship to intraday trading? Rather than saying it's either or, I think of it rather as and or both, and that there are times that I'm ready to do both. I feel more comfortable once I've got them well coded and defined in a top down approach, but I'm prepared to use my bottoms up approach to trade opportunities that I see, and I'm willing to investigate the potential for developing theories that can move across and then be tested deductively and then lead to a deeper understanding of the market. But I'm also willing to trade simply on the basis of price action that I can frame in terms of reward and risk. And so this leads me in a blend of these two approaches to what I call swing trading one day at a time. So this is Ken Long from Tortoise Capital. Thanks for your kind attention.